Hello and welcome to Investment Insight, your clear take on the markets. Let's get started. We are diving deep today into what really feels like a fundamental restructuring of the global economic order. If you've been operating on the principle that efficiency and finding the absolute lowest cost were the goals, well, you need to recalibrate your thinking immediately. We are officially in an era where national security, geopolitical rivalry, and most importantly, control over core industrial materials. That's what dictates every trade flow and investment decision now. The old model of a simple, frictionlessly efficient global economy is it's giving way to something much more fragmented and costly.
That's a crucial distinction for you to internalize, and it means the whole rulebook for investing has changed. We've synthesized some recent, pretty high-stakes analysis focusing on 3 interconnected shifts that are already impacting profit margins globally, and they're rewriting the risks right here in the U.S.
Okay, so what are the 3 shifts?
First, we'll explore the escalating materials war in Asia. Specifically, it's targeting the inputs needed for advanced semiconductors, the absolute foundation of, well, all future technology.
Right.
Second, we're going to look at how this Asian conflict is forcing a painful, very expensive supply chain restructuring across Europe. It's effectively imposing a massive structural new cost on global manufacturing.
As your tax, basically.
In a way, yes. And finally, we'll connect those global pressures back home to the critical state of the U.S. economy, which is showing clear warning signs of the worst-case scenario, stagflation.
Stagflation, slow growth plus high inflation, the worst of both worlds. It sounds like we're navigating a minefield, but the mission of this deep dive is to, demystify these complex forces. We want to break them down into simple, actionable strategies. By the end of this conversation, you will have a clear blueprint for fortifying your portfolio against this volatility.
Okay, let's unpack this and begin with that semiconductor battleground. So we've been living in an era of technological competition, but the recent actions between Japan and China, this feels different. It signals a dramatic escalation.
It is.
This isn't about slapping tariffs on finished products anymore. This is about cutting off the fundamental ingredient needed to manufacture your competitor's most ambitious industrial goal.
Yes, achieving self-sufficiency in advanced microchips. Japan launched a decisive, really surgical strike, and China retaliated almost instantly.
Okay, so this is what you mean by materials as weapons.
This is the definitive example. To really understand the gravity of what Japan did, we have to talk about one specific material. Photoresist?
Photoresist, yeah. Think of Photoresist as the highly specialized, incredibly sensitive ink that you need for the most precise printing job in human history, semiconductor lithography.
Lithography.
Yeah.
That's the process where they essentially etch the circuits onto the silicon wafer, right?
Exactly. Imagine trying to draw a line that's thinner than a human hair, and you have to do it billions of times without a single error.
Wow.
That requires these highly specialized light sources like extreme ultraviolet or EUV and argon fluoride immersion technology. Photoresist is the material that reacts to that light. It allows those microscopic patterns to be transferred onto the wafer. It is the core enabling ingredient.
The blood of the chip, as the analysis called it.
It's the blood of the chip. Without it, you have nothing.
And according to recent reports, Japan just decided to stop selling the most advanced versions of that blood to China.
Precisely. We saw definitive action from the Japanese Ministry of Economy, Trade, and Industry. They significantly tightened export standards on advanced photoresists to China effective December 1st. And this includes both the EUV and the ArF immersion types. You need those for manufacturing cutting-edge chips, 7 nanometer and beyond.
So it's technically a tightening of standards, but what does that mean in reality?
In reality, analysts are treating this as a functional, full export halt. Chinese manufacturers simply cannot meet the new stringent requirements. It's a closed door.
So why does Japan have this overwhelming leverage? I mean, why them, and why did they choose to use it now?
It really comes down to market dominance, a quiet industrial monopoly that Japan has cultivated over decades. The data shows that Japanese firms JSR, Tokyo OHK Kogyo, and Shin-Etsu Chemical collectively control between 70 to 80% of the global photoresist market.
Overall, 70 to 80%. That's huge.
It is, but it gets even more extreme when you narrow that down to the absolute most advanced, highest purity photoresist needed for those cutting-edge chips. Their dominance exceeds 90%.
90%.
Over 90. There is simply no substitute available globally at the required scale and quality level. It just doesn't exist.
And the timing. Why now?
Well, recent analysis suggests this action is very closely coordinated with U.S. pressure on China's semiconductor ambitions. China was recently showing signs of breakthroughs in their own advanced manufacturing, despite previous sanctions.
So this was a preemptive strike.
A preemptive, decisive blow. The geopolitical calculation shifted. The decision was made to leverage Japan's unassailable position in materials to target the input supply before China could achieve true manufacturing scale.
That is just overwhelming leverage. What's the immediate tactical effect of cutting off this bloodline for Chinese chipmakers like SMIC or Huawei?
It creates an immediate existential crisis for their entire industry. Recent analysis indicates that these major Chinese chip leaders, they reportedly have only a fragile supply buffer of this critical material. We're talking 1 to 2 months max.
1 to 2 months, that's nothing.
It's nothing in this industry. Given the lead times and the complexity of these operations, this puts their existing production lines at serious risk of a slowdown, potentially leading to a complete shutdown as early as January 2026 if they can't find a workaround.
And here's where it gets really dynamic. China's response, they didn't take this sitting down. The retaliation came within, 24 hours?
It was a classic example of targeted retaliation. It was designed to hit Japan where it hurts most, their core industrial export engine.
Just
Cars. On December 2nd, the Chinese Ministry of Commerce announced it would begin reviewing and restricting exports of specific materials essential to Japan's manufacturing base.
Okay, so what materials are we talking about?
This action specifically targeted processed graphite or rare earth permanent magnets. And this is on top of existing restrictions they already had on things like gallium and germanium.
So let me get this straight. Japan restricted the key material for China's high-tech future,
Right.
and China countered by restricting the core materials for Japan's current cash cow, which is electric vehicle manufacturing.
Precisely. The target is the massive Japanese electric vehicle sector. Companies like Toyota and Honda are deeply reliant on these specific rare earth permanent magnets for their high-performance EV motors.
And the graphite.
Processed graphite is essential for the anode side of lithium-ion batteries. You can't make the battery without it. By restricting this supply, China threatens to disrupt the entire global EV supply chain for Japanese manufacturers. It adds costs, it adds uncertainty to their most important product line.
It's a very precise strategic strike, a warning shot.
It's meant to demonstrate that these actions hurt both sides.
But China isn't just focused on hitting back. They're also trying to build their own resilience, right? This so-called red chain push. How serious is that effort?
The effort is immense. It's non-negotiable for Beijing. They view this as an economic declaration of war on their industrial independence.
So they're throwing money at the problem.
Immediately. The response has been a rapid injection of emergency funds from their national semiconductor fund, rushing capital to domestic photoresist makers like Tongcheng and Kempor. The goal isn't just to make chips. It's to create a fully redundant domestic supply system, the red chain.
And it's not just money, right? The government is forcing the issue.
Yes, we're seeing intense administrative guidance. That's the term for it. Chinese companies are being directed to use domestic materials regardless of the current lower quality or higher failure rate.
So they're willing to make worse chips just to get off the Japanese supply.
Exactly. They are sacrificing yield-producing fewer good chips per wafer just to qualify and establish a functioning domestic supply network. They are prioritizing technological independence over short-term profitability. That's a dynamic foreign investors have to understand.
But you mentioned earlier that the physical properties of photoresist make it hard to get around these restrictions. Why can't China just, find a third-party country to buy it from and smuggle it in?
That's a critical technical detail. It makes the sanction uniquely difficult to bypass. Photoresist is a chemical compound that's highly sensitive to both light and temperature.
Okay.
More importantly, it has a very short shelf life, often only 3 to 6 months.
So you can't stockpile it.
Exactly. This short lifespan makes large-scale hoarding or long-term third-party inventory impossible. If you try to ship it halfway across the world multiple times or store it in a non-climate-controlled warehouse, the quality just degrades instantly. It becomes useless for advanced manufacturing.
So their WTO complaint is more for show than anything else.
It might generate headlines, but the material science ensures the pressure is immediate and real.
So given this intense, materials-focused geopolitical conflict,
Yeah.
let's get to the actionable investment insights for the listener. If materials are weapons, how do we invest defensively and offensively?
Okay, the first major insight is focusing on the direct, immediate beneficiaries of this forced decoupling.
Right.
China has to replace 90% of its high-purity photoresist supply immediately. And they will turn to the only viable alternatives with established, albeit smaller, production capabilities. And that means Korean component manufacturers.
The Sobujang companies, as they're called in Korea.
Yes, Sobujang materials, components, and equipment makers.
But wait, if the Japanese materials have a 90% market share, doesn't that imply there's a pretty big quality gap with the Korean alternatives? Won't that risk the reputation of the Chinese fabs if they switch to potentially inferior materials?
That's a sharp point, and it's a major short-term risk, but the geopolitical imperative just overrides those technical concerns right now. China is prioritizing supply availability over initial yield rates.
They just need to keep the lights on.
They need to keep the lines running. They will accept a higher failure rate in the short term to ensure their production lines don't shut down and to develop their domestic suppliers. And this creates a dual demand boom for Korean firms. Not only is China turning to them, but the Korean domestic giants, Samsung, SK Hynix, they'll simultaneously accelerate their own localization efforts to reduce their reliance on Japan.
So they're getting business from all sides.
Massive demand for their domestic Sobujang suppliers. So for you, this means you need to watch key names in the Korean material space. Companies like Dongjin Semichem, which is a leader in localized RF photoresist, along with Solbrain and ENF technology. They are all expecting significant valuation re-ratings.
So they're the immediate structural winners.
Stepping right into the vacuum created by this political maneuver.
Okay, that covers the advanced chip side. What about the older chips that China currently makes, the ones that go into everything from wash machines to cars?
Yeah.
If their production lines shut down, that affects everything, doesn't it?
It does, and that brings us to insight number 2, the legacy chip shortage possibility. China controls a massive portion of the market for older generation, less advanced chips, often called legacy or mature node chips.
The workhorses.
The workhorses, exactly. They're used in industrial controllers, basic appliances, automotive systems, a lot of IoT devices. If Chinese production significantly contracts, the global supply of these ubiquitous components will immediately tighten.
And prices will go up.
Prices will jump significantly for legacy chips globally. This is a clear short-term boon for foundries that specialize in these chips outside of China. Think Taiwan's Vanguard or Korea's DB High-Tech, and even Samsung Foundry, which maintains legacy capacity.
It also helps distributors, right? The ones holding inventory.
Absolutely. It benefits distributors holding significant inventory of these specific older chips, allowing them to sell at inflated prices. So you should keep a close watch on industrial chip pricing as the new year begins.
So the long-term takeaway here seems to be a structural shift where material self-sufficiency is going to define industrial policy for years to come.
Absolutely. This confirms that material self-sufficiency will be the dominant multi-year investment theme moving forward. You, as an investor, must understand that global governments now view supply security as a crucial element of national defense.
Right.
This means we should expect massive, sustained government spending through 2026, and likely beyond across critical areas. This includes semiconductors, yes, but also specialized battery components, rare earth processing, and high-purity inputs for biotech and pharma.
So the play is investing in companies that enable domestic or friend-shored production in these core areas.
That is the structural theme that provides resilience in this new, fragmented environment.
This intense conflict in Asia, the photoresist war, the graphite counterattack, it's far from contained. The ripple effects are already being felt globally, and they're forcing Europe to confront the painful high cost of supply chain decoupling.
Yeah, and this entire section is really about acknowledging a brutal reality. The era of ultimate efficiency is over. For the last 3 decades, companies prioritized the lowest possible cost, relying heavily on centralized, just-in-time manufacturing in Asia.
And now that's a liability.
Now, security and reliability trump cost. And that shift comes with a measurable, staggering price tag. We're seeing data from the EU Chamber of Commerce survey that confirms this painful reality. The sourcing transition, the move away from centralized Chinese sourcing is accelerating, and it's driven not by politics alone, but by a corporate survival strategy.
How many are moving?
Nearly half of European companies surveyed are actively moving sourcing or production away from China. They simply can't afford the risk of having their supply chain weaponized or disrupted by the US, China, or Japan.
And the cost of that shift is huge. We heard projections of a 20% increase in revenue costs. Is that happening now?
It is now manifesting as real pressure on margins. European firms that are forced to find alternatives, say moving sourcing of specialized lithium from China to Australia or graphite processing from Asia to Canada, they're facing what we call the triple threat.
Okay, break that down for us. What's the triple threat?
The first element is significantly higher logistics costs. These alternative sources are often less developed and further away. Second is rising raw material prices from less established, often less efficient non-Chinese sources.
A third.
The third is the most insidious, expensive, time-consuming process changes. The new materials, even if they're chemically similar, often require retooling and recertifying entire manufacturing processes.
So you have to change your whole factory setup.
It adds major capital and labor costs, and this triple threat severely compresses operating profit margins for traditional manufacturers who relied on that razor-thin efficiency.
This cost shock sounds particularly devastating for Europe. They were so deeply reliant on both Eastern and Western supply chains. It sounds like they're caught in that supply chain sandwich you mentioned.
They are absolutely squeezed. It's critical for investors to understand this dependency crisis. European companies traditionally had a high reliance on two major blocks: Japanese high-tech inputs like the photoresist we just discussed, and vast quantities of low-cost Chinese resources.
And now both are unreliable.
They can't rely confidently on either major supply block anymore.
So if Japan restricts advanced materials, that hits German machinery production. And if China restricts graphite, that hits the EV battery supply for European automakers. The structural headwind seems, well, unavoidable.
It is unavoidable, and that leads directly to our first investment insight for Europe. Extreme caution is advised for traditional European manufacturers.
Which ones specifically?
We're talking about the firms with high Chinese exposure, both in sales and sourcing, and, crucially, limited pricing power. These are the companies that can't easily pass a 20% cost increase onto their customers.
Our example.
Consider major players like global chemical giants, BASF, or large-scale automakers like Volkswagen. These companies depend fundamentally on massive scale and efficiency. A 20% structural cost increase, as noted in the survey data, is not a minor headwind. It can wipe out their net income.
Wow.
Especially when coupled with slower consumer demand. Investors need to either avoid these stocks entirely or potentially consider strategies that bet on a margin squeeze for the foreseeable future.
Okay, that addresses who to avoid. On the flip side, who wins when the supply chain moves? If Europe is forced to move production, where is it going and what infrastructure supports that migration?
Right, so we shift our focus to the friendshoring and reshoring beneficiaries. When these multinational corporations decouple from China, they need new, reliable places to manufacture. And that drives massive demand for industrial infrastructure and development in specific new manufacturing zones.
Where are we seeing the money flow?
The key locations seeing the largest capital influx right now are in Eastern Europe, particularly Poland and Hungary. They offer skilled labor and proximity to major Western European markets. And beyond Europe, we're seeing major shifts toward India and Vietnam.
So the play is companies that build things in those countries.
You should look for companies specializing in industrial real estate development, logistics infrastructure, and heavy construction in those specific emerging markets. This is a multi-year growth trend fueled by geopolitical necessity.
These new networks, though, are so fragmented. The management must become exponentially more complex. That sounds like a massive technological opportunity.
Yes, complexity is the new inefficiency, and managing it requires high-tech solutions. When you source materials from 5 different countries and assemble them in a 6th, the risk management burden explodes.
You need to see everything at once.
You need systems that can monitor inventory, logistics, and geopolitical risk in real time across this fragmented network. And this drives serious mandatory demand for sophisticated AI-based supply chain management, or SCM, software solutions.
The companies like SAP.
Exactly. Major platform providers like SAP, which offer integrated next-generation software designed to monitor and optimize these increasingly diverse and complex networks. They're positioned for structural growth. This technology is no longer a nice-to-have, it's critical survival software.
And finally, let's bring this cost increase back into the broader macroeconomic picture. This de-China cost, as you call it, is a new source of structural inflation, isn't it?
It is absolutely structural. We call this phenomenon greenflation. Inflation driven by the necessary but expensive transition away from efficient, often polluting Chinese production toward more secure, diversified, and often domestically focused sources.
So the days of cheap stuff from Asia keeping prices down are over.
That era is officially over. This shift fundamentally alters the global inflation baseline. For you, the investor, this confirms the need for reliable inflation hedges in your portfolio. We advise focusing specifically on non-Chinese raw materials, particularly industrial metals like copper and aluminum. They're essential for the energy transition and the infrastructure build-out required for reshoring.
What about energy?
The energy sector, often overlooked as a defensive play, remains a crucial and effective hedge against this new structural inflation dynamic.
So while the rest of the world grapples with this high-cost fragmented supply chain, the U.S. economy is facing a profound internal crisis. We're transitioning now to the domestic front, focusing on the formal warning of stagflation. This isn't just market paranoia anymore, is it? Official data is now confirming the risk.
It's the scenario that keeps central bankers awake at night. We use the analogy that it's like the economy catching a cold, meaning recession or slow growth, and simultaneously suffering from a high fever, meaning persistent, stubborn inflation.
The worst economic outcomes at the same time.
Exactly. The 1970s is the classic case study of how devastating this combination can be.
And now an official body is flagging this risk.
Yes. The risk was formalized by the December 1st OECD Economic Outlook report. The data was sobering. The U.S. 2026 GDP growth forecast was significantly cut to a paltry 1.5%. That is a serious slowdown. That's the cold setting in.
On the fever.
Critically, the report simultaneously projects that inflation will remain above the target rate, confirming the fever will not easily break. This official pronouncement moves the risk of stagflation from theory to reality.
And we saw immediate real-world confirmation of that cold side, the consumer slowdown, right after that report came out.
We did. The crucial Black Friday shopping expenditure reports came in, and they were a major indicator of consumer distress. Overall spending fell 4% year over year. That's the first decline in 4 years.
4% doesn't sound like a catastrophe, but it's the direction that matters.
It's the direction, and it's strong, tangible evidence that a mild recession is already active within consumer sectors, driven by constrained purchasing power.
Let's dig into the specifics of that consumer pullback, because I saw some of the data and certain categories just dropped off a cliff.
They did. The details show where consumers are being forced to cut back. Reports indicated a massive 76% drop in apparel expenditure.
76%.
And a 56% drop in electronics. This is a clear flight from discretionary, non-essential goods. Consumers are using their limited funds to cover rising necessities, utilities, rent, groceries, and aggressively pulling back on big-ticket items.
It signals their savings are gone.
Their savings buffers are depleted, and debt servicing is consuming a larger share of disposable income. And if you look at what did do well on Black Friday, it was essential retail, grocery stores, mandatory home necessities. This divergence is the textbook sign of an impending consumer recession.
This puts the Federal Reserve in an absolutely impossible dilemma. They were already cutting rates in September and October to try and support growth, but the inflation fever still hasn't broken.
Their actions have arguably been too little, too late. Despite those cuts, inflation persists. The October core PCE, which is the Fed's preferred measure of underlying inflation, was reported at 2.9% year over year.
Still way above the 2% target.
Significantly above it. They are failing to control the fever even as the cold rapidly sets in.
And this agony is causing total market confusion heading into the upcoming FOMC meeting. They are truly stuck between a rock and a hard place.
The market is in total flux because the Fed faces two mutually exclusive bad options. Option one, do they cut rates, which the market is pricing in with a high probability, to try and save the slowing growth and avoid a deep recession?
Ooh.
Or option two, do they hold or even hike rates to try and finally choke off that stubbornly persistent inflation?
So the chairman's recent comment about a cautious approach was basically him saying, we have no idea what to do.
It's a verbal reflection of this agony. They know that whichever path they choose, they risk making the other problem worse. Cutting risks in an inflationary spike, holding risks, plunging the economy into a painful recession.
This brings us to a fascinating point from the analysis. The U.S. is suffering from uniquely high inflation pressure compared to its peers in the G20. Why is this a U.S.-only inflation problem?
That's a critical differentiator. While many G20 countries are seeing their inflation stabilize and move closer to target, the analysis clearly shows the U.S. is projected to suffer uniquely high inflationary pressure through 2026. The sources point directly to the lingering aftermath of the tariff wars.
Ah, the tariff boomerang. Let's break down that mechanism.
Yeah.
How exactly does past trade policy create persistent inflation today?
It's important to remember who actually pays tariffs. Tariffs are a tax paid by the domestic U.S. importer, not by the foreign manufacturer. When those tariffs are in place, they become a permanent fixed cost for U.S. companies sourcing goods abroad.
And that cost gets passed on.
Eventually, yes. The foreign producer might absorb some of it initially by lowering their margins, but eventually that fixed cost is transferred directly to the U.S. consumer through higher retail prices.
And because the U.S. hasn't really diversified away from those supply chains, the cost is just baked in.
Exactly. It's embedded in the price structure. This creates a vicious, self-sustaining cycle. High import prices transfer cost burdens to the consumer, which contracts their spending and slows growth, leading us right back to that stagflationary environment. This particular cost burden is structurally unique to the U.S. trade structure among major peers.
This is a challenging environment, to say the least. It demands a complete portfolio overhaul. So let's pivot entirely to the crucial question. How do investors construct a portfolio to survive, and maybe even thrive, during stagflation?
Survival in a stagflationary period requires pivoting entirely away from the classic growth-focused strategies of the last decade. We'll start with fixed income. Standard General Treasury bonds are poor inflation hedges.
Because their fixed interest payments lose value.
They lose real purchasing power as inflation rises. You have to favor TIPS, or Treasury Inflation-Protected Securities.
And why are TPS better?
The core advantage is that their principal value is adjusted based on changes in the Consumer Price Index, the CPI. It directly protects your purchasing power from inflation. For instance, if you hold a $1,000 bond and inflation rises by 5%, the principal value of that bond adjusts to $1,050.
It keeps pace.
It keeps pace. Also, given the radical uncertainty about the Fed's direction, maintain liquidity by holding short-term T-bills. They minimize interest rate risk while you wait for clarity.
Okay, moving to stocks. The only thing that matters, as we discussed in the Europe section, is pricing power.
It is the only thing that matters. If costs are rising structurally, only companies that can pass those costs along without losing customers will maintain their profit margins.
So what are we looking for?
We recommend focusing on two key categories. First, defensive stocks. These are mandatory purchases, consumer staples, things like food and necessities, healthcare and utilities. People still have to eat, pay their utility bills, and take their prescription medicines regardless of a slump. Their demand is inelastic.
And the second category?
Look for monopolies or platform companies with irreplaceable technology or market dominance. Think of established tech giants like Microsoft, Amazon Web Services, or Google's advertising business.
Because you have no choice but to use them.
Right. If your entire business runs on their cloud platform, they can raise their subscription fees to offset their own rising costs, and you, the customer, have no practical choice but to pay it.
And what to avoid is pretty clear.
You must rigorously avoid companies highly sensitive to cyclical consumer spending. Apparel retailers, general retail, travel stocks. The exact sectors hit hardest by that Black Friday shock.
Given the unique U.S. inflation pressure, that tariff boomerang, does that mean we need to look beyond U.S. borders for greater stability?
Absolutely. The DUSA diversification strategy is essential right now. If the OECD analysis is correct, and the U.S. is uniquely stagflating while other major economies stabilize, then focusing solely on U.S. assets is a self-imposed limitation, a significant risk.
So where should people be looking?
You should actively investigate global markets with more stable inflation profiles and potentially better growth momentum. This includes emerging economies like India, which is benefiting from global supply chain fragmentation, and stable, value-driven stocks in Europe and Japan, where equity valuations may be more attractive.
And finally, the classic defense against inflation, real assets.
When currency loses value due to structural inflation, real assets become the ultimate store of value. Gold is a prime example. It's been approaching record highs due to both geopolitical safety demand and the expectation of eventual rate cuts.
So how much of a portfolio should be in real assets?
We would recommend allocating a defined portion, say 5 to 10% to real assets. That can include physical gold or commodity ETFs that track essential industrial metals. They act as a necessary protective barrier against this structural inflation.
This has been a critical and pretty extensive deep dive. The core lesson here feels non-negotiable. The global economic model has definitively pivoted.
It has.
Efficiency is yielding to security. We're exiting the comfortable era of low-cost, friction-free sourcing and entering a high-cost, fragmented, and volatile environment defined by structural inflation. For you, the investor, the pivot must be immediate and tactical. You have to shift your focus entirely from prioritizing growth at any cost to focusing exclusively on resilience, liquidity, and most importantly, pricing power in every single holding you own.
And the long-term thematic shift toward material self-sufficiency. It means that national defense budgets are quietly transforming into R&D and manufacturing budgets for critical industrial materials. We just watched photoresist become an economic weapon overnight.
Right.
This raises a crucial question for you to mull over as you restructure your portfolio. Which seemingly benign, overlooked material, maybe a specialized industrial lubricant, an advanced composite, a complex pharmaceutical enzyme, which one will become the next critical, unreplaceable choke point that governments leverage? That is where the next major geopolitical and investment shocks will originate.
That is a fascinating and frankly somewhat alarming thought to end on. It reminds us that we have to always look beyond the headlines to the actual physical inputs of the economy. Thank you for joining us for this deep dive into the markets. Don't forget to subscribe and hit that like button.